Hello everybody, now we're going to understand how the stock market works. What is the stock market? For almost everyone, the stock market is something as mysterious and strange. Most of people have always heard in the news journalists talking about how the stock market is performing and what is going inside the global markets. Sometimes the market is going up and other times it's plummeting. When the stock market is bearish or going down, the red signal is triggered. By the way, we are the Finance Trigger, and today we're going to discuss about the stock markets. You are going to understand fundamentals of stocks and how markets work. On top of that, you will understand when it's a good opportunity and it's time to buy stocks. Understanding how stock markets work will help to earn extra money. Stay tuned with us until the end of the video. Let's go! First of all, let's understand what happens on a regular market. Imagine you want to buy something like a t-shirt and you go shopping for it. Finally, you get your desired and favorite one and agree to pay $30 for it. Did you realize you just made a trade? Congratulations! You just gave money in exchange to receiving a product. Great job! Now imagine this amazing t-shirt, and there are only 100 of those t-shirts in circulation around the world, and above all, a lot of people want this t-shirt. What will happen? The demand will rise and retailers will run out of stocks for this desired t-shirt. Suppliers see it as an opportunity and will increase the price to retailers, and retailers will also increase their price and margin. The new price of the same t-shirt is now $50. After a while, more retailers realize these nice products and decide to sell it. As for now, people have more chance to buy the product, as the t-shirt is sold in different places. Because locations are increasing and supplies of this product also increase, the amount of t-shirts available in the market increases. What will happen then? The demand will decrease and retailers realize the price will decrease drastically. Let's assume the price drops to $10. Depending on the law of supply and demand, the price of the same t-shirt will be different. Stocks are performing similarly on the market. On the stock market, you always have a price that depends on the law of supply and demand. Which products can be found on stock exchanges? You need to understand how company stocks are operating. You can also find other exchanges, such as commodities, forex, futures, options, and other derivatives products. You don't need to know everything, you just need to focus on the ones you're interested the most when it comes to investing. Let's focus on stocks. As a common term, a stock is defined by a small unit of a company itself. Usually when a company begins, owners resort to get finance through private capital like banks, angel investors, venture capitals, etc. After some years of being on the market, company can decide to go public if budgeting is great enough to get even more financing. Thus, public companies are becoming more accessible to everyone, and everybody can decide to invest in the company. Private investors tend to push owners to go public on a stock exchange, so they can sell the shares at a better price. When we refer to shares, we also refer to stocks. In both case scenarios, companies appear to be on stock exchange, and this can lead average investors or normal people to get on board. Everybody will be able to buy shares of public company traded on the exchanges. Shares are part of companies under the form of a contract that stipulates shareholders during time of holding shares. When the company goes public, it issues a number of limited shares available on the stock market. A price will be fixed depending on demand of the first trading day. At this time, you will probably hear about IPO or initial public offering. You will know that this term means companies are public entities. Let's go back to our example of a retailer. People that are considered buyers will demand stocks of a company, and other people that are regarded as sellers will sell stocks on the market to buyers. In a nutshell, thousands of trades will be negotiated between buyers and sellers on a daily basis. Why is the market so unpredictable? The market responds to the emotion and impulse of buyers and sellers. As people's behavior are unpredictably irrational, price of same stock can go up and down in a short time. IPOs tend to be great companies with a great cash flow, so the tendency of any volatility is highly reduced. Every time you see a green or red signal on the news, it means people are buying or selling a huge amount. It's almost impossible to predict the markets. Sometimes the market will favor buyers, and some other times sellers. Variation of prices will call for volatility and can lead to a shift in the investing behavior of the desired market. The key is to remain calm and never panic under any circumstances. Unlike derivative assets, stocks are not made of thin air and are backed by green financial sheets that record any loss or gain during fiscal years. That's pretty much the greatness of investing in stocks. Behind each company, you can analyze teams, intangible and tangible assets, cash flow available, losses and gains, products and services. Everything helps you to get a better knowledge of the company you're interested to invest. If a company is strong and stable, it doesn't matter if the volatility is high. In the long term, you need to look at the company and not the price of a stock. To sum it up, the stock market is a great place and a wonderful exchange in which everybody is allowed to buy and sell shares or stocks, like going to a shop and buy a t-shirt. The price of a stock will highly depend on the amount of demands of investors. When more people are investing blindly and speculating on the stock market, price will soar and achieve new time highs. This action can end up in a bubble in which the price is way above the realistic price. Sooner or later, the bubble will burst out. We've seen it several times throughout history and during recent time periods. Most of us know when prices increase too fast, the price will be rectified, and this leads to a bullish market or price going down when the bubble bursts out, creating a new economical recession. That's why you should always be cautious and always invest money you don't need on the stock market. You need to find the right balance between your risk and rewards. Here you had some of the basics of the stock market. If you want to learn more about investing and find out different ways of earning money, stay tuned with us. We will dive deeper on these investing streams in future videos. If you like this content, subscribe to our channel and give a like. Thank you so much, and see you next time.